Gold just experienced its most brutal weekly crash since 1983. In India, the price of 10 grams plummeted by more than 7,000 rupees in a single day, bottoming out at 137,377. The damage extended far beyond the MCX. Global spot gold dropped to $4,372 an ounce during its 9th straight session of losses, while silver simultaneously crashed 6%. This chart shows the scale of the reversal. Just weeks prior, gold was celebrating a 95% yearly gain, peaking at over $5,600 in January. Even with global geopolitical tensions rising, the world's oldest safe haven asset began behaving like a highly volatile, risky investment. This price collapse represents the visible result of a chain reaction, a series of invisible financial dominoes falling across the global economy. The trigger point was the closure of the Strait of Hormuz, which immediately paralyzed critical global shipping lanes. That bottleneck caused oil prices to spike 75% over the year, instantly reigniting fears that global inflation would spiral out of control. Inflation fears forced the U.S. Federal Reserve to abandon planned rate cuts. Instead, they held the Fed rate at a high 4.75 to 5%. Higher interest rates make government bonds highly attractive to institutional investors. Since bonds offer a steady yield while gold pays nothing to hold, interest in the metal evaporated. These sustained high rates acted as a magnet for foreign capital, pushing the US dollar index to a multi-month high of 100.50. With gold priced in dollars, the surging greenback made it too expensive for foreign markets. Demand in India and China, the primary consumers, collapsed. An energy crisis in the Middle East artificially strengthened the US dollar, suffocating gold's buyer base and creating the conditions for a crash. As the surging dollar pressurized markets, the impact hit the micro level on trading floors, crushing both paper trading and crypto. Brokers responded with margin calls, demands for immediate cash to cover the mounting losses in these digital accounts. To meet margin calls, traders were forced to liquidate their physical gold, their only asset sitting on major January profits. This sparked mass profit-taking. Investors scrambled to cash out before prices fell further, accelerating the massive downward spiral. Gold crashed because highly leveraged traders required immediate cash to survive a separate crisis in the crypto and paper markets. While retail investors sold in a panic, institutional smart money interpreted the crash through a different lens. Central banks are largely ignoring the short-term volatility. They are continuing to accumulate physical gold as a hedge against unresolved global conflicts. Major financial institutions view this 1983-level plunge as a mechanical liquidity event caused by a temporary need for cash rather than a loss of gold's long-term value. This chart shows forward-looking projections from major banks. Despite the crash, they maintain aggressive targets, with gold expected to reach $6,000 an ounce by the end of 2026. Fund managers interpret this price drop as a rare, highly lucrative discount window for long-term buyers. The March 2026 crash functions as a violent reset, an engineered clearance sale for smart money before an expected rebound.